In the bustling corridors of Wall Street, where numbers dictate narratives, Tesla is often reduced to a single lens, that of an automaker. Over the past 12 months ending in early 2025, Tesla delivered 1.7 million vehicles, a figure that, alongside its cumulative total of 7.5 million cars sold, underscores its dominance in the electric vehicle market. Yet, to view Tesla solely through this prism is to miss a broader, more transformative story. Growth in car sales may have tapered, prompting analysts to question the company's trajectory amid a global automotive slowdown. But what if the essence of Tesla lies not just in vehicles, but in the batteries that power them, batteries that extend far beyond the wheels of a car? By reframing Tesla as a battery company, a different picture emerges, one of explosive growth, untapped potential, and a profound impact on the world's energy landscape. Consider the electric vehicle itself. At its core, a battery with wheels. This simplicity invites a question. What happens when those batteries stand still? Tesla's energy storage business, encompassing megapacks for utilities and power walls for homes, offers an answer. In the first quarter of 2025, Tesla deployed 10.4 gigawatt-hours of storage, a near-record performance eclipsed only by the previous quarter's 10.6 gigawatt-hours. This figure, primarily driven by the Lathrop, California factory, reflects a 154% year-over-year growth rate on a trailing 12-month basis, a staggering ascent that Wall Street has largely overlooked. With the Shanghai mega factory now operational as of late 2024, and a third facility in Texas on the horizon, Tesla's energy division is poised to redefine the company's identity. To understand this shift, one must look beyond the traditional metrics of car sales and explore the equivalence of energy storage in automotive terms, a perspective that reveals Tesla's true scale. A Megapack, Tesla's flagship storage product, is a behemoth designed to fit on a semi-truck, a deliberate choice balancing capacity with transportability. Each unit stores approximately 3.9 megawatt-hours of energy, though for analytical simplicity, a rough estimate of vehicle equivalence can be derived using the average Tesla car battery size of 75 kilowatt-hours. Dividing the 10.4 gigawatt-hours deployed in Q1 2025 by this benchmark yields an astonishing insight. This single quarter's energy output equates to the battery capacity of roughly 138,000 vehicles. On a trailing 12-month basis, the 38 gigawatt-hours deployed translate to about 506,000 vehicle equivalents. This is not a hypothetical exercise. It's a tangible measure of Tesla's dual identity, producing not just cars, but stationary vehicles that store and distribute power. The energy business's trajectory is nothing short of remarkable. Since Q4 2016, Tesla has cumulatively deployed 73 gigawatt-hours of storage, a number dwarfed by its current annual capacity of 90 gigawatt-hours, split between Lathrop's 40, Shanghai's 40, and Powerwall's 10. This capacity, already underutilized at less than half in the past year, signals explosive growth ahead. The Shanghai facility, operational for mere months by Q1 2025, has begun shipping units to Australia, while Texas's third factory, leveraging existing infrastructure for rapid deployment, could come online by early 2026. Unlike car factories, which demand billions and years to build, Megapack plants require modest investments, around $200 million, and can repurpose existing structures, accelerating expansion. Tesla's leadership has acknowledged battery constraints, forcing tough allocations between vehicles and storage. Yet, as Elon Musk noted in the latest earnings call, we're a battery company. Where we put them is the question. Wall Street's myopic focus on car deliveries, 1.7 million over the past year, down slightly from 1.8 million in Q4 2023, belies this broader reality. The auto industry faces headwinds, rising interest rates, a global recession, and softening demand. Analysts fixate on these figures, questioning Tesla's valuation at over 100 times earnings for a seemingly stagnant automaker. Yet, when energy storage is factored in, the narrative shifts. Combined, Tesla's vehicles, those with wheels and without, total over 2.2 million equivalents in the last 12 months, a figure that continues to climb. Energy, though currently contributing roughly 15% of Tesla's $100 billion 2024 revenue, up from 10% the prior year, boasts higher profitability than autos, a margin that amplifies its impact as it grows. At this pace, energy could rival car sales in volume within 3 years, rendering it impossible to ignore. This growth is not merely numerical, it's structural. Megapack factories offer a superior return on investment compared to auto plants, requiring less capital and complexity. A car's assembly involves intricate drivetrains and electronics, while a megapack is a simpler assembly of batteries and software. This efficiency fuels Tesla's ambition to scale energy production rapidly, potentially 1 factory per year. The Shanghai facility's true capacity may exceed its stated 40 gigawatt-hours, hinting at deliberate understatement, while Texas's plug-and-play approach promises swift activation. By 2026, Tesla could deploy over 100 gigawatt-hours annually, equivalent to 1.3 million cars, doubling today's output with existing and imminent infrastructure. The demand for such storage is insatiable, driven not by consumer whims, but by systemic needs. Utility grids worldwide groan under strain, exacerbated by renewable energy's intermittency and AI's voracious appetite. xAI, Musk's AI venture, recently faced power fluctuations at its Colossus data center, resolved by megapacks smoothing the supply. As AI proliferates, projected to require thousands of data centers globally by 2030. Energy storage becomes indispensable. Amazon's AI hub beside a nuclear plant and others near hydropower illustrate generation solutions, but megapacks address distribution, balancing spikes and lulls. A single data center with 100,000 GPUs demands a symphony of power management, precisely what Tesla's AutoBidder software, an AI-driven tool, optimizes. In select markets, Tesla even earns revenue shares from energy arbitrage, capitalizing on price volatility, while 20-year service contracts, roughly 0.5% of a megapack's cost annually, promise recurring income. This energy narrative, however, is but one thread in Tesla's tapestry. Beyond cars and storage loom robo-taxis and Optimus robots, ventures poised to eclipse even this growth. Energy may enjoy its moment, contributing significantly to profitability over the next few years, but autonomy could render it a footnote. Imagine Tesla's 7.5 million vehicles, already on roads, activated as robo-taxis via software updates, each multiplying its utility fivefold. Optimus, meanwhile, hints at a labor revolution, though its commercial dawn remains distant. Wall Street's reluctance to embrace energy foreshadows a similar lag with these frontiers, yet the numbers are unmistakable. Analysts, often autocentric, miss the forest for the trees, neglecting a division that's too big and too profitable to dismiss. Tesla's impact transcends balance sheets, reshaping the world in measurable ways. Consider its 7.5 million vehicles, a fleet saving 3.2 billion gallons of gasoline annually, based on an average car traveling 13,500 miles yearly at 32 miles per gallon, versus gas prices of $3.25. This translates to $10 billion diverted from oil companies each year, a figure that, while a fraction of global consumption, marks a seismic shift from a $1 billion impact 5 years ago. In China and Norway, where EVs dominate, air quality improves, noise fades, and cities transform. Add 25 million gallons of motor oil saved, no changes needed, and reduced brake dust from regenerative braking, and the environmental footprint deepens. Gas stations, once roadside staples, face obsolescence, forced to adapt as convenience hubs for EV drivers who linger longer and spend more. Autonomy promises to accelerate this transformation. A robo-taxi future could cut transportation costs, a good deflation, though it may paradoxically increase traffic as convenience spurs travel. Cities like Singapore and Hong Kong already ration road access. Autonomous lanes or human-free zones could follow, mirroring the paved roads and gas stations born of the car's advent. Urban redesign looms, parking lots yielding to parks, drop-off zones replacing street parking, enhancing livability. Yet, challenges persist. Integrating human and robotic drivers, managing congestion, and navigating unintended incentives. History suggests adaptation. Telephone operators faded, economies endured, but the scale of AI in robotics tests this resilience. Tesla's mission, once sustainable energy, now evolves to sustainable abundance. This shift, articulated by Musk in 2025's all-hands meeting, envisions a world where robots and autonomy unlock unprecedented productivity. If Optimus outworks humans, 7,000 hours annually versus 2,000, and AI supplants cognitive tasks, labor as we know it could vanish. Production might soar, costs plummet, yet without jobs, how does society function? Musk proposes a universal high income, not mere subsistence, a radical reimagining of economics. Taxing robotic output to fund this remains a thought experiment, but the implications are profound. Tesla, with its cars, energy, and nascent AI, stands at this precipice, driving not just a company's growth, but a civilization's future. Wall Street may cling to its car-centric view, but Tesla's reality defies such simplicity. Its energy business, already a 500,000 vehicle juggernaut, surges toward parity with autos. Its environmental dent, billions in fuel savings, cleaner cities, grows daily. And its AI horizon, robotaxis, robots, abundance, looms larger still. This is no mere automaker. It's a force reshaping energy, mobility, and society. The numbers speak. The world shifts. Tesla's story is only beginning.